Welcome to Global Intel. Today, we uncover billionaire strategies. How do they use charities to sidestep taxes? It's a clever, legal tactic hidden in plain sight. Stay with us as we break down the mechanisms, loopholes, and the ethical questions. First, let's set the stage. Billionaires have teams of accountants and lawyers. They specialize in tax optimization. To many, charity is a noble act. But for the ultra-wealthy, it's a financial maneuver. Donating isn't just goodwill. It's a tool to reduce taxes. How does that work? Let's explore. One common strategy involves donating appreciated assets, like stocks. Here's how it works. Imagine a billionaire owns stock worth $100 million, purchased for $10 million. Selling it triggers capital gains tax on the $90 million profit. But donating the stock lets them avoid that tax. They receive a tax deduction based on the current value. That's a double win. No tax on gain and a deduction reducing taxable income. Now, you might wonder, didn't the billionaire give away $100 million? Not always. Many set up private foundations or donor-advised funds, or DAFs. These are like personal charity bank accounts. Billionaires get immediate tax breaks upon donating. But the funds may sit in a DAF or foundation for years before reaching actual charities. In the meantime, they control investment strategies and can pay family members to manage the foundation. It's charity with strings attached. Let's discuss private foundations in detail. Billionaires create these to manage charitable giving. It sounds altruistic, but there's a catch. A foundation must distribute only 5% of its assets each year. The rest can grow tax-free. Billionaires can appoint themselves as trustees, keeping influence over assets. Some foundations fund causes aligning with the donor's interests, blurring charity and self-interest. Donor-advised funds offer even more flexibility. Think of a charitable savings account managed by a third party. A billionaire donates, gets an immediate tax break, and recommends grants on their timeline. In 2023, DAFs held over $200 billion in U.S. assets. There's no legal requirement to distribute funds quickly. It acts as a tax shelter disguised as philanthropy. Another tactic is the Charitable lead trust. Here, a billionaire places assets in a trust, paying out to charity for a set period. This reduces their taxable estate. After that period, remaining assets pass to heirs with little to no estate tax. It's a method to transfer wealth while claiming a tax deduction. The numbers are staggering. These trusts can shield millions. Now, let's address ethics. Is this wrong? Legally, no. These are established provisions in tax codes. Critics view it as a loophole. They argue it lets the ultra-wealthy manipulate the system, lowering their tax burdens. Public services like schools rely on taxpayer dollars. Conversely, defenders say billionaires' donations support critical causes neglected by governments. The debate revolves around intent, genuine philanthropy or tax avoidance. Data supports this practice's scale. According to the IRS, in 2022, the top 1% claimed over 30% of charitable deductions. They earn 20% of total income. The ultra-wealthy benefit from tax breaks tied to complex assets. For example, donating art yields a massive deduction based on appraised value, sometimes inflated. They retain influence over how it's displayed. So, what's the takeaway? Billionaires use charities to optimize wealth through legal strategies. They donate assets to avoid capital gains, create foundations to maintain control, and use trusts for estate tax minimization. It's a system rewarding generosity and amplifying wealth preservation. Understanding these tactics empowers you to see the bigger picture. What do you think? Is this fair use of the tax code or a loophole needing closure? Drop your thoughts in the comments. Like, subscribe, and hit the bell for more insights from Global Intel. Until next time, stay informed and keep questioning.